This is a investment analysis for gold. Before I start this video, please remember I do these videos just for fun as a hobby and always speak to a qualified financial advisor before making any investment decision. So the reason why gold's got onto my radar is because it's just completed this epic cup and handle formation. You have this cup here which actually spans a decade, making it one of the most epic cup and handle formations I've ever seen. And then you have the handle here, which we've broken out of. So technically, this looks very bullish. And just for extra security, we have the all-time high here in 2020, and I'm suggesting that I would wait until we break above that and are comfortably closing above that all-time high to totally confirm that we're into this bullish mode. Now, the risk, if I was to set a stop loss of 20% to sell half and then about 27% to sell the rest, which would be, if we started falling below this low, there'd be no doubt that we'd failed in the technical thesis. The risk would be about 2% of my portfolio if I put about 10% of my portfolio into this bet. However, the reward, and I'll go into this later, could be something like a 6x. So it's a good asymmetrical bet based on the technicals. Now, how I plan to go into this is through the 91 Global Gold Fund, which for me is what's gonna work out the best tax wise and everything, and without having to store the gold myself. If you're interested in gold investing, though, I'd suggest you go and take a look at the Sovereign Saurus YouTube channel. This guy has been nice to me in the past, commenting on some of my videos, and I really like his channel. He's fairly down to earth. He's more of a actual store of physical gold, but can give lots of information, and he's fairly honest and open about the risk factors with investing in gold. And if you find those videos, there's a lot of good stuff there. Another YouTube channel which I watch is Maneko64. Now, be careful because this guy is an absolute extremist when it comes to gold stacking. It's a very biased channel, and he's actually sponsored as well by some gold sellers. So be very wary with this channel, but there is lots of really interesting information in this channel as well. This is more of a kind of politics and economics gold channel, and there's some really interesting insights to be found here. But like I say, be careful because these guys are extreme stackers. Now, the 91 Global Gold Fund it actually invests in gold miners. What I've found is if you overlay the performance of that fund with the price of gold, the way it's performed is it may as well be a bet on the spot price of gold, even though it isn't really supposed to be that. Although actually I was interested initially in investing in a gold stocks ETF kind of thing. The best I'm hoping for here is a match on the increase on the price of gold. With this fund, I don't think you will get more leverage beyond that when I look at the price history. However, I'm going to go through this analysis based on going into this fund, but I'm also going to do some follow-on videos where I look at some of the stocks in that fund. And also, there are 3 UK stocks which I've found which are big enough to be serious. And I'll take a look at those as well because they might offer a bit of spice as well by investing in those. So first of all, taking a look at the gold price historically, actually in 1971 was the end of the Bretton Woods system, and this was a system where the US dollar was kind of pegged to gold and backed up by gold to some extent. And in 1971 that ended. So since then, the US dollar became a fully fiat currency. That's a currency that's essentially just printed with nothing backing it up. And you can see this better on this chart, which is from the Macro Trends website. And here you can quite clearly see that the gold price was as still as a mill pond as long as the US dollar was pegged to it. And then the moment they lifted that, you can see a big repricing, and it kind of repriced dramatically and then kind of stabilized. So we got this 7x, and then it stabilized, and for many, many years did nothing. Interestingly, in the dot-com bubble, that crash, the price of gold didn't actually do anything. This spike here was when all of the European central banks suddenly announced that they were going to not sell gold, which led to that spike. But that had nothing to do with the dot-com bubble. And it's interesting how that crash in the stock markets didn't really affect the price of gold at all. And then we had in the noughties, and this time period is associated with the beginning of full-on new Keynesian economics, where there's lots of money printing and zero interest rates. This period, there was a 6x increase in the gold price. And I think, although you could make out perhaps two pumps, actually, I think that the financial crisis itself punctuated what was actually one big rally here, which was a 6x rally overall. And then we have this enormous cup and handle formation. And what I've determined actually is that this spike here and this spike here, the two highs, in fact, the all time high in 2020, these did coincide with lots of ETF buying of gold. And during this drop here, actually, the ETFs were selling gold. So that's something I have managed to make out. But we kind of do have also this, other than that, we do have this kind of price rediscovery here, followed by this huge cup and handle formation. We've broken above this cup and handle formation, which is supposed to be very bullish. And like I've said, I've set in for myself this extra hurdle of closing above the all-time high for final confirmation. Looking into what could be the reasons for the price of gold going up, one thing I've got here is the money supply. And of course, ever since the end of the Bretton Woods system, where governments could then just print money however they liked, essentially, we have seen lots of progress in terms of the growth of the world economy since then. And there is this kind of exponential growth in the M2 ever since the move towards fully fiat money. Now, the M2, that's the US dollars in existence, and then that's cash in circulation plus bank deposits plus certificates of deposits. And then you also have the M3, which is the identical pattern, and that also includes money held by institutional investors. However, when I marked up the increase in M2 since 1970, year 2000, and 2020, put alongside that the gold price, we see actually the gold price has gone up a lot more, 50x since 1970 and 7x since year 2000. However, when I take a look at the gold price here using the Macro Trends website, and then I click on the inflation adjusted button, we still see that the price of gold has gone up as a trend, and it seems to be since 1970. It kind of adjusted for inflation. It's almost all over the place, but you could very crudely say it kind of goes up linearly, but with just a horrendous amount of swinging either side. Well, when I look at the multiple, actually, the price of gold has only gone up 6x when you adjust for inflation against the M2 number of 28x, and only 4, and the same as M2 since the year 2000. So there's no clean cut association here I can draw upon. I can't help but noticing that ever since we moved to fiat, there is a clear exponential trend. This got messed up a bit by the Wuhan outbreak anomaly here, where obviously there was incredible money printing, and that led to this anomaly here. But what I would say is, if you think that M2 is going to now decrease from here, then that would, very crudely speaking, there is a crude association that would be bearish for gold. But if you expect that now that we're back to this exponential line, it's going to continue on an exponential path, then that could very crudely be bullish for gold. And my base case, now take a look at the video I did recently on the S&P 500 and also my macro update I did in the US as well. But my current base theory is that the governments are going to continue to do a lot of money printing in order to win votes. And I look at that fatalistically as the course that the current globalized capitalist system is stuck within, and it's going to be stuck within those rails until it breaks. And that's just my own personal pet theory, okay? But I do favor the idea of, for those reasons, the M2 continually to increase following this trend until, maybe in a decade or something, it just becomes impossible to maintain mathematically, really. Then we could find ourselves either in some kind of MMT experiment or with a final breakdown of the system. With that as my base case, I can very crudely say that if you think that the M2 is going to continue in a exponential pattern like it has done since the beginning of truly fiat, the US dollar, that could be bullish for gold. That could be bullish for gold when we look at the price of gold the since the beginning of a fully fiat US dollar. However, when I've tried to drill down into the numbers and things, there's nothing I can really grab hold on to mathematically. This is just a very crude theoretical association there. So I've looked at the supply and demand for gold, and if you go to the World Gold Council's website, there's lots of information and some data there that I've been using. They have this schematic here where you see the size of a person against all the gold that's ever been mined in the world. And of course, gold is a immutable element, so once it's mined, it can't be destroyed. That is quite impressive. That doesn't look, when you consider that's the gold on the entire planet, it is quite impressive how scarce gold looks when you look at this diagram. And then they've got here saying that this is the gold reserves that exist on the earth. And when you look at that, that looks like, wow, gold really is scarce. But when I dug into it, I found that that's just the reserves. And then when you look at gold resources, which I got from other places, then actually there's a lot of gold resources. Now, obviously, they're going to be more expensive to mine, and you need to invest in those mines first to extract that gold. This is the gold that is available through current mining operations. So yeah, there is an element of scarcity, but I think that the World Gold Council, for obvious reasons, are a bit misleading here with this, because I think there is plenty of gold actually to meet the current amount of gold being mined. However, at the current rate of gold mining, that should exhaust the current reserves. So we need a higher gold price, you could say, and money coming into the gold mining companies in order to keep feeding the markets with more gold. We see here how through time, particularly South Africa and other places, were centers of gold mining where gold was first discovered and exploited. Currently, it's actually China and Russia are the main areas, the biggest areas mining gold. I've got here the gold production through time, and frankly, this doesn't look good for the gold price because, the trend is that there's just ever more and more gold being extracted through time. And you do wonder how the gold price has done so well. Based on this, however, you do wonder though if we do get to a kind of peak gold situation. In recent years, it has started to flatline a bit. Maybe we are in a peak gold kind of situation, but all the same, there's a lot of gold being mined in recent years, kind of up, which kind of unsettles a bit my ideas around people's ideas around the scarcity of gold. Now, when we look at the gold in existence, a third of that roughly is jewelry. And obviously, you get some of this when in hard times people go and take their jewelry to the pawnbrokers, and it getting recycled. But you also need new jewelry being made because obviously, when people buy wedding rings and things, they like to buy a new one, not a second-hand one. But there is a certain amount of churn in this the gold that's in existence here, which kind of then makes creates these kind of undercurrents that make price prediction a bit more difficult. This other here, this is gold being used for technology, and then you have central banks accounting for 14% of gold that's in existence, and then bars and coins are 18%. And it's quite interesting that there's more gold just being stored by rich people than there are gold being stored in the central banks. I've got here from the World Gold Council how much demand there's been for each of those use cases. We can see that the amount used for technology is stable. The thing that seems to be moving around the most here, jewelry is by and large stable. It does vary a bit, but really the one thing that seems to have been affecting things the most is ETF flows. And interestingly, in 2013, we saw lots of flows, lots of gold coming out of ETFs, and then that led to this drop in the price. And then the recent spike in the price seems to coincide with lots of gold flowing into ETFs. So I have managed to find one causal effect here, which is gold flowing in and out of ETFs. I've used the World Gold Council data to then do a fine detail look over the last 5 years. We know that there was lots of gold flowing into ETFs that coincided with this spike. And then again, with the 2020 spike, here you can see lots of gold coming into ETFs, contributing to that price spike where we got the all-time high for gold. Now, actually, the way this gets plotted by Excel, the negative numbers, which you can see there, here, they come up actually as a positive, but then it seems to then delete from the rest or something. But the ETFs are actually been negative recently. We see again that the technical use is nice and stable. And actually, recently, the rich people storing gold and the jewelry is actually stable. You can see that here. We had a drop in gold being used for jewelry around the year, obviously, when we had the Wuhan outbreak. But otherwise, jewelry use is stable. And as you can see here, the tech use is stable. So, in fact, the recent increase in prices are mainly through to central bank buying. And you can see a clear step change here in central bank buying of gold, which obviously coincides with confiscating lots of Russian US dollars. And it makes sense really that a lot more central banks around the world will be buying gold because they won't be wanting to buy US dollars so much anymore because of the risk of the government confiscating it. The reason why there's been reasonable stability is because people have been taking gold out of ETFs. So there is a bit of there is a bit of a causal effect here of central bank buying and ETF buying, explaining recent increase in gold price. One thing I found a bit alarming was that if you look at gold supply and gold demand, there's actually less demand than there is supply every year. And this shortfall gets made up by what they call over the counter and other when I looked at the data. Now, I don't really understand this very much at all, but it's something to do with the over the counter gold markets and gold exchanges throughout the world. And this is quite notorious as being a very opaque market. And so that is a bit troublesome because it adds a whole factor of uncertainty towards trying to understand the gold price, because you've got a significant amount of gold that's kind of going into this black hole. So there it adds a uncertainty factor when you're trying to predict or assess the price of gold. So that, in combination with, obviously it's hard to predict what the ETFs are going to do and what the central banks are going to do, means that I'm left with a position that I can't rationalize my way into investing gold. There's too many moving parts which render gold, as far as I'm concerned, a speculative bet. You really are in the zone of making a speculative bet here based on technicals, albeit with a nice backdrop of a very crude association that maybe there's a coincidence here that ever since we went off the gold standard and had fiat US dollars and unlimited money printing, we have a exponential growth in M2. Possibly that could have a very rough correlation with how the price of gold has gone up ever since the US dollar had no gold backing it. So I plan to wait for gold to close above its all-time high for a good few weeks to confirm this cup and handle, in which case I'll go in, I'll put about 10% of my portfolio in with potentially, if history repeats itself, a 6x return. For me, there's a very good asymmetric bet here, a nice risk reward profile where I'm only risking 2% of my portfolio anyway. Following my look at what causal effects I could find, there's all kinds of moving parts and areas of uncertainty, particularly around the over the counter markets and exchange markets and what the central banks and ETFs are doing. And so that really does render this in the category of a speculative bet for me. So that completes my investment analysis for gold. I hope you found it useful, and good luck with your own investments. I do videos like this one just for fun as a hobby. It's for entertainment purposes only. Always consult a qualified financial advisor before making any investment decision.